If you sell your first home in Clovis, California right now to move up, you're leaving $2,400 a month on the table and you're giving up a 3% interest rate forever. I'm going to show you the math that no one else is showing you on camera, step by step. By the end of this video, you will know exactly how to keep both houses, how the numbers actually work, and what to do in the next 36 days to take advantage of a promotion I'm running out of my own pocket. So stay with me. Here's the standard advice every bank, every lender, every realtor, and everyone is well-meaning family member in Clovis, California is giving to move up families right now. Sell your starter home, take the equity, use it as a down payment on your bigger house, move in, done. That advice is wrong. Not because it doesn't work, it works, but because it leaves a massive amount of wealth on the table for a Clovis family who could have done something different. Now, let me walk you through it and what I'm seeing. You bought your first home in Clovis, California, somewhere between 2018 and 2021. You probably paid anywhere between $300,000 to $450,000, maybe $600,000. You probably locked a rate somewhere between 2.75 and 3.5%. Your principal and interest payment is probably between $1,200 to $1,700 a month. Sound right? Today, that home is worth about $497,000 roughly. That's the Zillow median for Clovis. And you have somewhere around $200K in equity. And that's where standard advice kicks in. You sell, you write a check to the realtor for 5%. That's about $25K out of your pocket. You pay the closing costs, all the title fees. You walk away with maybe $170K in your pocket. Then you buy a $700,000 home that you move up into. You put down that $170,000. You finance $530,000. At today's rate of 6.5, your new principal and interest payment is about $3,350 a month. Add property taxes plus your insurance, the works, you're maybe at $4,300 a month all in. Now, two things just happened that nobody pointed out to you. One, you gave up a 3% mortgage rate forever. That rate is gone. When you sell your home, if you ever want to live in that house with a 3% interest rate, you'll need to wait until the next pandemic. Two, you wrote a $25,000 check to realtors to sell a house you didn't have to sell. That's 3 years of your kids' gymnastics gone. Now, let me show you the other way. This is what I call the move up equity multiplier, and it's the core of the mindful lending move up method that we have. Instead of selling your first home, you take a HELOC against it, a home equity line of credit. At today's national average, those rates can be anywhere from 7 to 7.5 on the HELOC. You pull, let's say, $100,000 against your equity. So you're going to get $100K, but you're going to make a payment to pay that back. That HELOC payment is roughly $700 a month. That $100K becomes your down payment on the $700K move up home. You finance the rest, so a $600,000 loan amount at 6.5%. Your new principal and interest payment is about $3,790. Add taxes and insurance, you're about $4,700 all in. Yes. Now that's $400 more a month than the standard advice version. Hold that thought. Now here's what you do with the first home. You don't sell it, you rent it. In Clovis, California right now, single family homes are renting for an average of $2,700 a month, and that comes from apartments.com. 3-bedroom rentals are about $2,400 a month, so 4 bedrooms are about $2,700. Conservatively, your first home rents for about $2,400 a month, conservatively. Now that $2,400 is going to cover your original payment on the first home, and let's call that $1,500 just to be safe on your house, your current house payment, and it covers the HELOC payment of $700, and you have $200 left overall per month in cash flow, which is great. The renter is paying down your principal, the interest on your first home, the HELOC payment being serviced, and you have a positive operating cushion, roughly. So yes, your move-up payment is $400 more a month than the sell and buy version, but now you own 2 homes. Both are appreciating, both are building principal. One is being paid down by a tenant, and you never give up that 3% interest rate, which is free money. Not really, but kind of. Now, quick story. When I was 19, I crashed a motorcycle. I shattered my upper cervical spine, my shoulder blade. Now, a doctor told my parents I'd struggle with logical thinking for the rest of my life. Now, after 19 years of yoga, meditation, breath work, I run this math every week now. I've closed over 150 loans across 6 states. So when I tell you the standard advice is wrong, I'm telling you because I've watched families take the standard advice and re-get it within 18 months when they realize they gave up. Let me run the 10-year picture. First, we'll start with the standard advice version. You sell your home first. You own one $700,000 house at a 3% annual appreciation. That house is worth about $940,000 in 10 years. You've paid down some of the principal on that loan. Your equity is maybe $400K. You wrote a $25,000 check to a realtor at the start. Using my move up equity multiplier version, you kept the first home. You own a $497,000 house and a $700,000 house. The total is $1.2 million in assets. At a 3% appreciation in 10 years, you have $668,000 plus $940,000. That's a $1.6 million in real estate assets. The first home is being paid off by someone else the entire time. The HELOC gets paid down as the first home appreciates, and rents always rise. Your net worth in real estate is roughly $250,000 higher in this scenario than the standard advice version, conservatively, roughly. That is the cost of the standard advice, $250,000 over 10 years per family. Now, this strategy is not for everyone. There are 3 conditions that have to be true all together simultaneously. I call it the keep and climb window. 1, local rents in your specific zip code have to cover the original payment on the house, plus the HELOC payment, plus a little leftover, plus a little small cushion. So in Clovis, California today, for example, with rents in the $2,350 to $2,748 range per month, this is open for most 2018 to 2021 buyers in Clovis. So if you bought a house in 2018 to 2021, you're kind of sitting in this spectrum. Number 2, your income has to qualify for the new mortgage with the rental income from the first home applied as a lease offset. So essentially we submit a lease to underwriting and that will offset the payment of your current home so you can afford to buy the next home. This is a W-2 income, debt to income ratio, lenders specific guidelines for counting rental income. So not every family will qualify. We'll have to run. Okay, so it can work for non-W-2 workers. Number 3, the move up home you want has to still be priced where your family can actually afford it and reach it. Clovis prices are down 3.1% year over year right now. This condition is wide open. 12 months ago, it was tighter. 12 months from now, who knows? We'll just have to see. When any one of those 3 scenarios break, the window closes for your family to move up and the multiplier doesn't work anymore. You have to sell to move. And that $250,000 in long-term wealth, it's gone permanently. Here's the truth nobody wants to say. This window doesn't stay open forever. It's opened because of a specific combination of low pandemic era interest rates that were issued out in 2018 through 21, current rents right now for Clovis, California, and current move up prices. When rents drop and your debt to income ratio changes on your income or move up prices run away, the door closes. That's why I've put my own money on the line for the next 36 days. Through June 30th, Mindful Lending is running something we're calling the lock and drop special. If you lock a move up primary purchase loan with us before June 30th, I will personally pay to drop your interest rate by 1% for the entire first year of your loan out of my pocket. On a $550,000 move up mortgage, that saves you and your family about $345 per month. So about $4140 in year 1 is what I'm paying for. On a $700,000 move up, more typical of a Clovis, California move up number, it's closer to $440 a month you save in the first year with the special, which is about $5,280 in year 1. On a $750,000 loan, it's almost $6,000. This is real money in your account. While your kids are settling into the new bedrooms, free to you, free to the seller, doesn't cost them any money. Move up primary purchases only, not investors, not rate shoppers, not refinances. Locked with Mindful Lending before June 30th. Here's what you do Monday morning. You request the move up sale analysis worksheet. Link is in the description. It's the diagnostic. It runs the actual numbers on your specific home, what it would net you to sell, what would it rent for, what the HELOC math looks like, what you'd qualify for on a move up, whether the 3 conditions are open for your family right now or not. It's free, no call required, just the worksheet, your numbers, and the truth. If the math works for your family and you want to lock in the lock and drop rate before June 30th, book a clarity call. And the link's in the description. I want you to picture 12 months from now, you're sitting on the back porch of your move up home. The yard is finally real. Your 2 kids each have their own bedroom. Your first home is still yours. A tenant is paying down the mortgage every month. Your 3% rate is intact. And that house is quietly compounding for your family. You bought a $700K home, but the first year cost you're $5,000 less than your neighbors paid because of a lock and drop special I'm offering you. You did not write a check to a realtor. You did not give up your rate. You did not take the standard advice. This is the move. So just comment lock and drop below and I'll send you the worksheet and the clarity call link directly. You handle the family, I'll carry the math.